3, 2, 1.
All right. I'm going to say people maybe are watching this show on Christmas Day.
I hope they're not watching it on Christmas Eve.
Or Christmas Day, for that matter.
I was thinking, well, this comes out on Christmas Eve, and I was thinking, man, if you're watching this on Christmas Eve, you're bored, you're tired of your family already, or something. Well, if you celebrate Christmas, Merry Christmas. If you don't celebrate Christmas, Happy Holidays. Happy whatever. We hope you guys are watching this at some point. And when you are, we hope you're having a good time with family or friends or somebody.
You should watch it with a little cup of eggnog.
Absolutely, and Irish it up a little bit.
Exactly.
All right, man, what we got?
So we are a couple days actually before the 24th because I'm going to be out of town for about a week. And so we're recording a couple days early, but it doesn't really affect anything. Hopefully the market stays doing what it's been doing for the last couple days.
We don't hope.
That's true. We don't.
We'll still be watching it. We just,
of course.
It won't be in this podcast.
All right. So I got 2 Facebook comments that we're going to talk about. And then because it opens up some concepts that we have to keep going over and over, and that's fine. And part of that is going to be the allocations from the last Grow Model portfolio change. So if you guys are not subscribers to the site, you get a chance to take a look at what we put out, the depth of analysis that we put out on these alerts. And then, so what happens when the Fed lowers rates? Everybody who's looking at anything, it knows that the Fed has ended its rate hiking cycle, and the reason the market is rallying is because in anticipation of the Fed cutting rates, and it's just a question of how many times they cut rates in 2024. And then we'll take a look at the TSP fund charts. Okay, so here's a comment. For the first time in many months, my TSP balance is slightly in the positive for year to date. I've followed all the reallocation alerts this year, but the poor performance is really making me question whether or not I should go back to my good old buy and hold in the CNS funds, which I did well with most of the time for 30 years. I have a comment to Jerry. Tell us what he will do differently next year to improve performance. I hope he has a podcast on this. Okay. And then somebody else commented to that. One thing I learned from following this page is that buy and hold is a more reliable strategy than trying to time the market. GMTSP alerts caused me to miss out on a pretty big jump over the summer, so I stopped following them immediately and went back to holding CNS up 18% now for the year. Okay, where to begin? So, the top, the main comment, right? If you have been CNS for the past 30 years, buy and hold CNS for the past 30 years.
Right.
Okay.
So let's show everybody what that looks like.
Okay.
Yeah, let's get on that because it's a good chart to look at while we discuss.
Yeah. Okay. So this is the S&P 500 on a monthly basis, going back to 1990. So a little bit more than 30 years. But basically, this is your career. If you've been in for 30 years. Been in for 30 years. This is your career.
Which is very close to what we tapped out a little while ago, but pretty close to us.
Yep.
So we are very familiar with this last 30 years. Yes.
Yep. Very familiar. And one thing for sure, from my perspective anyway, is what I don't want to do is be in a position to accept something like this. Okay.
And by the way, we didn't. I don't mean necessarily just grow my TSP like this. We weren't doing this back then. Jerry was, as a kind of a side thing, but personally, we didn't. Our TSP accounts didn't, because we were using this sort of strategy. Okay, not to say it's perfect. I'm just saying that one of the initial things that we've said from the very beginning is our goal is just not to lose a lot of money, right? And sometimes we're not going to make as much, but anyway, I'm gonna let you keep going.
Yeah, no, that's right.
I'm not gonna derail you.
We weren't doing this back in the day, but I don't remember exactly back here. I definitely didn't. I mean, we were working together during this part, and I didn't have any losses in 2008. Yeah, it's 2009. I don't remember back here.
Yeah, we were pretty busy back then.
Yeah, but we did. If you, I mean, the alerts are up there we missed the whole COVID decline, and we were down 0.7% last year. So we missed the COVID decline, we missed this decline, we missed this decline. Did we get all these gains? Nope, absolutely not. Did we get all these gains? Nope, absolutely not. So if you are, back to the commenter, if you are 30 years into it, your perspective can be whatever floats your boat, but your perspective should be, how do I not lose anything? Because you can't contribute anymore.
Mm-hmm.
You should have something planned for that money, right? You should be, you've worked 30 years to build it. You're going to spend it somehow, hopefully, because that's what it's for. But if you're making withdrawals, let's say, to supplement your, for whatever you're doing in retirement, can you take, if we're here, which we don't know, but if we are here, and you go back to a 50-50 CNS buy and hold, so let's just say it's 100% C fund because this is the chart. This is a 50% loss, right, from 2000 to March of 2002, right? So in 2 years, you lost half your money in buy and hold. Imagine you have $1 million in your TSP account today. In 2 years, you're taking withdrawals every month to supplement your standard of living or whatever. The market keeps going down. You don't look at it because you're buy and hold. You don't
right,
care.
Let's make sure we remember that part.
Right.
If you're saying you're going back to buy and hold, that means stop watching the podcast, stop watching Bloomberg. Don't why? Because you're not.
No, you're buy and hold
because
you're buy and hold. So you're
a passive investor. Nothing wrong with that.
Nope. Nothing wrong with it.
Don't take those comments to mean that we're being flippant or no. Some people just would rather be passive about it and let the market do what the market does. But what we're showing you here is the devil's in the details, right? Yep.
I mean, imagine if you're not really watching it because you are passive and you're not buy and hold, so you're not really focused on the market, and you look at your quarterly statements from TSP, and over the course of 2 years, you lose 50% of your money plus whatever the withdrawals were that you were taking out every month. I can't even imagine.
Well, I can't imagine, and I mean, you can too. I know you just said that, but I remember being in the office. Because Jerry and I worked not directly together at that point. We later did, but we were in the same 2 offices down or something. Yeah. I remember, and I don't mean to be flippant about this or funny because it's not funny because it really struck me. But I saw grown men cry. Yeah. Because they over time they were watching their balances just deteriorate and they wanted to retire. These were guys that were way late in their career, and I also knew some that had recently retired and were, I was talking with, and they're just like, what am I going to do? And I'm like, what you're going to do is start listening to Jerry. I was like, because we're not in right now. We're not taking these. And they're like, they didn't know that they could go to G. They didn't know that was even an option. They just didn't understand, right? And that's really what got us into all this was, wow, people really just don't understand their retirement accounts at all. Yeah. And there's nothing to say that buy and hold is a bad strategy. It's not the one we would prefer because we like to be a little bit more active in managing our retirement. Now, how active is a whole different story. We're probably very active, and that's not necessarily the best way, but it is the way we use. Now, to not get too sidetracked too much, let's go back to the comment because let's go back to the chart because not only are we talking about not taking those losses, but walk us through, Jerry, of so that was 2 years on the way down, and then 2 years. How many years back up? Yeah, well,
so this was the peak.
It's hard for me to see, folks. Yeah. So when I ask him, it's not because I can't see it; it's just so small on my screen.
This was 2000, the peak of the NASDAQ bubble, right? Peak of tech.
How long did it take us to get back to
that? To get back to that was a top in 2007. Which was the housing bubble and, financial inflation.
And then you wrote it back down.
And
where did we get back to our original high?
Yep. So the original high was in 2000.
Right.
And wrote it down, wrote it up, wrote it down. It took until 2013.
How long is that? I know how long it is. I'm just doing it for effect.
13 years.
Right. Come on, folks. Yeah, you have to. That's the part that we if anything we could get people to understand about this whole buy and hold thing that people throw around. First of all, you're not buy and hold if you're doing things.
Right.
Okay? You're just not. What you're doing is you're hoping that you chose the right buy and hold. It's not buy and hold. Buy and hold means you're passive. Right. You're buying the indexes and you're just letting them go because you don't want to manage them. And again, nothing wrong with that. It's a choice. Now, if you're choosing buy and hold when it suits you, that's just poor management. That just means you're hoping you chose the right thing and you don't really have a plan. Right? What we're trying to get you to see is there are ways to manage this. If you don't like our way, there's seasonal strategies, there's swing strategies, there's all sorts of strategies that you can use to implement. We use one particular one right now. The point is we have a strategy. We have a plan. Doesn't always work out perfectly, but we have one. And so if you're moving your money at all, you're not buy and hold. Now, you might have been buy and hold for 30 years, and now you've decided you're going to go back and forth. Okay, but that's not really how it works, because you can say that, but depending on when you decided to go back to buy and hold, or if you were buy and hold, in this case, right, you lost 13, you didn't lose anything, 13 years to get back flat again. Yeah. Flat, not having gained any money. And the thing I think most people miss too, about particularly like last year and this year. So people want to, write us about this year because we didn't catch everything. First of all, you got 2 moves a month. It's got to be in by noon. There's a lot of reasons why you can't time the market. Right. We're not trying to time the market. What we're trying to do is follow the trends. Right. And those trends have to be long enough, like they have been for the past few weeks, which Jerry's going to get into our most recent model change. And that one, the trend has lasted long enough for it to be useful. Right. And so, again, let's back up to last year, because I think this is important. Do you have last year?
There you go. It goes back to 2022.
Yeah, I love you, man. So Jerry's always got a chart for you. Sometimes it's not always handy, but
so the top one, just so you know, the candlesticks is S&P 500, and yellow or orange, whatever it is the S fund. Yeah. So if you were 50-50.
So you're not even back. If you were buy and hold during that time, yep. Folks, take a look at this chart.
Is the top in 22?
You're not even back to where you were.
Nope.
And you can't say, well, I would have been active in 2022 and buy and hold in 23. Right. What? That doesn't even make any sense.
Right.
You can't choose it like that. Unless that was your plan, then you executed it really well.
Yeah, great.
If your plan was to be out of the market in 22 because you thought seasonally or whatever your reasoning behind, if you truly had a strategy and you were out, and I do know people that did this, so it does work.
Sure.
There's a little bit of luck here, no matter what you're doing. Yep. Because we don't have a crystal ball. But if you were out of the market in most of 22 and in the market in most of 23, you're a happy camper.
Oh, yeah.
Now, you also have absolutely no idea what 24 is. But if that strategy that you're using to get you out in 22, in 23, works well for 24,
awesome.
Rock star.
Yeah.
And keep using that strategy. Like whatever strategy you figured out works for you.
Yeah.
Right? And so that's the important takeaway here. You can't pick these little, blips of time and judge performance, ours or yours, right? I'm not saying just our performance. Right. And again, most people are already going to think that like we're defending ourselves here. What we're really trying to do is educate you. Yeah. Because when we see comments like this, it tells us that they don't really have the full story, or they're ignoring it. That could be possible. You might know and you're just ignoring it.
Yeah. I mean, right? Another big part, there's so many aspects to this, but another big part of it is fear of missing out. And recency, hindsight bias, and the biggest thing I would say is the difference between actually managing your account versus sort of hoping for the best, right? So kind of that idea. This is the last reallocation that we did was on November, I think, 11th or 15th or something like that. And so I'm just going to do one chart, one of the tons of charts that we did. That was a really long alert analysis document, but this is the C fund on the day that we put out the alert. And people complain that the market, this is the bottom in October, and why didn't we somehow know that was going to be the final bottom? I mean, what you do when you're managing your money is what we do is we try to be on the right side of the trend. Okay. So what does that mean? The trend in this case...
The trend has to actually happen.
Yes, the trend has to happen. So in this case, you have lower highs and lower lows. The trend is down, right? All you have to do is connect the highs and the lows, and in this case, the highs, and when it breaks out of that high, you buy it. And that's what we did. I don't care that I didn't get these gains, because there's so much risk in those gains, it's not worth it. Right? This was with the way that we look at it on the time frame, the 2 moves a month and blah blah blah. That is when the trend changed, and that's when we got back in.
Everything else in between that line that Jerry's showing you right there is gambling.
Yep.
Everything. You have to accept that, or well, you don't have to. You don't have to accept anything, but you at least have to listen to that. And again, this is all meant to be educational, right? Because nobody else is going to talk about this stuff with you. They're not.
I mean, if you're not looking at a
different
chart,
come from.
Yeah, you have no basis to understand the ups and downs, daily ups and downs in the market, right? Anywhere, as long as you have lower highs and lower lows, until you break out of that trend, the trend is in place and it's going down. So,
if you could move every day and you didn't have to have it in by noon, you could.
Then you could work shorter trends.
Potentially take advantage of that. Absolutely.
100%, absolutely. But you'd be doing the same thing. It's just on a smaller time frame.
Right, because you had more flexibility.
Right.
We don't have it, and if you figured out a way, not the commenter, but I'm saying the larger you, out there, if you figured out a way to see those trends faster, and they actually allow you to, within a time frame that allows us to make enough moves within there. Yeah. How long a time frame is that? It's about a month and a half.
Yeah. So the top there was August. So this is September, October, November.
Yeah. So you had 6 moves in there, give or take, depending on how you did it.
Yeah.
If you could have made that work, good. Then you figured out a strategy that works for you.
Yeah. So
that's highly unlikely.
Let me point out this one, right? So we had a pretty good correction right here, right? Market finds a bottom, and then on that green day right there, a huge breakout in price. You're above that 20-day moving average line. That was a breakout. The market could have kept going higher, but it didn't. Right? There's just like that. There's no guarantees.
You got to wait till it breaks through that trend, and it could have gone. You don't have the line drawn at the bottom, but if you did. Right, just as easily, this last uptick could have come back down. Yep. There's nothing to say, and that would have what that would have told us is that the trend is continuing down, and we still wouldn't be in.
That's right.
We just wouldn't be, because there wouldn't be any reason to be in.
Right. So hopefully people are hearing this the right way. I am not defending this methodology at all. I mean, I'm very comfortable with it. I know it works, and I'm not defending it. Hopefully people are looking at this and going, okay, this kind of makes sense, that when the trend is in a direction, it stays going in that direction until it changes. And once we can identify that it changed, still no guarantees that it doesn't roll over, and then you just get out. And the same thing on the upside. So that's what we're trying to sort of demonstrate in this chart. So this was the end of the alert analysis. Okay, so I've had a couple of comments where people are
that's going to be hard to read.
Yeah, well, I'll read it. So, the difference between analysis to make decisions, particularly with respect to the percent allocations you're going to be in. Okay, we say all the time, our goal is not to beat the C fund or whatever. You look at the market the way it is. You apply the analysis and you make decisions. Okay, so with that in mind, this is the kind of analysis that we do. So here's the rationale. This is back in November, whenever the last alert was. This is the rationale for the percent reallocation that we did. Okay, there is reason to be bullish for all 4 core TSP funds. The C fund is clearly outperforming and must be part of that allocation. However, the C fund is also the most overextended of the stock funds. The S fund has less downside risk than the C fund. As a close below its recent low would be a sell trigger. So the S fund was closer to the buy trigger than the C fund was. C fund was way more extended. So the downside risk for the S was only that day's gain. Okay, because if it undercut that day's gains, I would have gotten out of it. Same goes for the I fund, where the downside risk was only today's gains. In the short term, the F fund has a similar risk profile to the S and I funds. Last week's pullback makes today's gap up the downside risk. So in that chart, this was the downside risk. If we came all the way back down and filled that gap and kept going. So this, if we got in here and you got out down here, this was the risk. Okay. So in the broader picture, the F fund is by far the least risky option at this point. As we've been discussing for several weeks, the long-term Elliott wave count on the C and S and I funds are all bearish. That does not change with one strong data point. Stocks are expensive. In contrast, the F fund bonds have been in an historic decline for almost 3 years. Bonds are very cheap relative to stocks. Given a completed 5-wave down in the F fund, a significant move higher from here in bonds is much more certain than a continued move higher in stocks. Okay, so we're not. That's analysis. That's making a reallocation decision for those reasons that I just read. Okay, so the bottom line, we had a CPI print that day, which is what kicked off that market gap up. But after today's CPI print, the market is pricing in a soft landing and no recession. The expectation is that the Fed will begin a rate lowering cycle within the next few months as inflation continues to fall. And as we know, that has played out for the past month and a half, right, since this alert. If things play out this way, stocks will continue higher, potentially much higher, which is what happened, because of the no recession narrative. Bonds will continue higher because bond price moves inversely to rates. As rates fall, the price of bonds goes up. And that is also what happened. And it's much more certain because the Fed is telling us that they're going to lower rates. They're telling us that the F fund is going to go up. It's a lot more certain when bonds are way undervalued.
Can we talk about the F fund for a second since you're there?
Sure.
So that's another thing I wanted to bring up before we went past this whole idea of, okay, I'm going to go buy and hold CNS because it's performed better this year than what I was doing otherwise, right? What are you going to do in a year, in a given year? I'm not saying that's going to be next year, but what do you do in a given year when you're watching the CNS tank and the F fund is going up? Are you going to ignore it? Are you going to say, well, that's just an anomaly. It's just 2018,
sure, yeah.
Right? We killed it because we were in the F fund, right. Not because we got a crystal ball or anything. The trend was there. Yep. Everything said, hey, the F fund looks like it's going to start outperforming. And, unfortunately, F fund doesn't move as fast exponentially like that CNS fund do, but it still goes up. And if you're able to take advantage of that, well, then your account balance is going up instead of down. And so just if you go back and re-listen to what Jerry just read off in that kind of alert analysis. By the way, the alert analysis, if you're not a member, like this is what comes out at some point during the day after we've decided to change our model. So we change our model when the analysis tells us. Now, it takes a while to write that up, so it doesn't come out at the same time. That's impossible because you have to have the move in by noon. So usually by 11 a.m., we've made our decision for the day, not to do anything or to do something. And so when that happens, the analysis comes out, and that kind of gives you the meat of why these decisions were made. It also helps you learn from, well, what made you choose, because this is where it really gets in the weeds. You can decide to be in the market or out of the market, right? But that's only one piece. Right. Where are you going to be at in the market, right? What weightings are you going to have? Right. That's where it really starts to get difficult. And really, you don't really start to learn that without a lot more knowledge and experience. Deciding when to be in, like if you were just going to choose the C fund, I'm in or out. That's actually not a bad way to start learning.
For sure, yeah.
Right? Not to say that you actually have to move your money that way, but a lot of times what we'll do, and I'll do specifically, I'll speak for me, not Jerry, but I have strategies that I'm playing out aside from this with like fake money. right? It's easy to set up an account with fake money. Fake money meaning it's just sort of like a training account, you know? And you can, like in TradingView or a Thinkorswim, like I have a Thinkorswim account that has $100,000 and it's not real money. And they let you test strategies. And so what you're able to do in there and go, okay, let me see how this is played out. Anyway, the point is that helps you start to figure out, why would I go 50C, 50S, or 75C, 25F?
Right.
Like, why would I do that? This helps you do that. So don't let those little nuances kind of float away. And trust me, it's very doable for you to learn how to do this. Nothing that Jerry is showing you there. Of course, Jerry's got 20-some years of experience at doing this, so he's able to explain this a lot better. But it doesn't mean it's any harder. It's not.
No, it's not.
Yeah, these are very... And Jerry can attest this, as you know, working on his chartered market technician, right? There are incredible amounts of things you can do as a real technician that we're not even close to. Why? Because we need to keep this simple enough for you guys to be able to replicate it yourself.
Yeah, and we only have 3 stock funds, 1 bond fund, and a money market.
There's no reason to get too crazy with it. But my point is that this is very doable. So I'll get back to your slide here.
So it's kind of to what you were saying about the F fund. Actually, let me just finish this because I think I talk about it in there. So after today's CPI print, we're pricing in a soft landing, no recession. Fed's telling us that bonds, the price of bonds is going to go up. So the risk the risk is basically zero for bonds. And you know, over the last 6 weeks, bonds have gone up, and so have stocks. So stocks, okay, let me just, in case I skip over this. On the other hand, many economists believe that the U.S. is already in recession. If they're correct, the stock market will roll over even in a rate lowering cycle. Bonds will continue higher as investors flee to the safety of bonds. So basically, while there are no guarantees, bonds are set up to do very well in either scenario. Okay, so there is the least amount of risk in bonds, but stocks go up more than bonds when both are going up. So do you want to be 100% CNS? Then you're risking, what if the stock fund, the market rolls over, then you roll over. If you're in the F fund, the Fed is basically telling you you're going to make money in the F fund. So you take all that into consideration, which is what we did, and we came up with the allocation for 20% C, 20S, 20I, and 40% F. Now, that is going to underperform. And it has underperformed for the past 6 weeks. Because with the 40% in the F fund has gone up a lot in terms of bonds. But it has not gone up as much as the S and the C funds have. But the risk, the risk is so much less in this allocation. And so if you are managing money, if you're managing your own money,
yeah, right.
You want your risk to be as low as possible, but also to make it perform. But if you spin back around and say, yeah, but I could have made 25% if I was buy and hold.
That's just emotional investing.
I mean, yeah. I don't mean to laugh. I honestly don't. And I know we're going to talk about this forever. This is going to be a show that we're going to end up doing forever. But
yeah, we have to, because this is one of the most important things for people to take away. And it's not really just for the people that made those comments. It's really one of the things that is lingering for so many years in this whole idea of managing your retirement account. 401ks, IRAs, TSP, all the same.
Yeah.
All the same principles, okay? Most of those, take the IRA out for a second. 401k and TSP very similar in the fact that majority of your availability in 401ks are mutual funds. The TSP, very simple, just a few funds. My point here is you don't have a lot to choose from, and you've got closing day prices, and you're limited in some fashion in 401ks. There's lots of different versions. We actually have a 401k for our company, and it's irritating to us, but it's the way 401ks work because we have the same kind of restrictions.
Yep. And the same choices, basically.
Pretty much
TSP.
the same choices. And why would you do that? And I'm not going to get sidetracked too much, but because I can hear someone saying, well, then why would you do it? Well, because you can put back, because of the law, you can put back much more in a 401k than you can in an IRA.
Right. So tax deferred. And
yeah. So if you're trying to maximize that each year, which again, we're in our retirement years and we're still trying to max out our retirement because we know that we're going to live longer than our grandparents did. Hopefully. So anyway, the point is managing any sort of retirement account, and I keep saying retirement account because let's put brokerage accounts over here on the
completely
side.
Completely
different world, tax implications, all those sorts of things are different than a retirement account. So a retirement account, you got limitations on how you can manage it. So you need a plan to manage it. And how you execute that plan can't be based off emotion. It can't be FOMO. It can't be, you're sitting on the sidelines and you've chosen your strategy, not just some hope, but you've actually chosen a strategy and you're not willing to let it play out over the long term, right? We follow, or I do more probably sometimes than Jerry, but the seasonal strategy folks, I like some of that stuff. I really think it's cool to see. Wow, if because most of that's looking backwards, right? But if you say, wow, if this seasonal strategy, making these moves throughout the year based on these things, would have performed really well, and it could continue. But what you see people doing though is switching strategies like every 3 months,
right?
And okay, that's not how it works. No. Seasonal strategy, at least most of these are set up for a year, at a minimum, and then they change it for the next year, not every 2 months or 3 months. What? That's not the.
That's how most people lose the most money. Go back to the buy and hold thing, right? If you're down 50%, are you seriously gonna say? So here's what happens. You got $1 million and the market's down 10%. Now you have 900,000. You're buy and hold. You're like, it's okay. It's gonna come back. It always does. It drops down. Now you're 20% down. So now you're 800,000. It's okay, Mark, it'll come back. I'm a little bit more nervous now, having a harder time sleeping, but it's okay, it'll come back. Goes down 30%, 40%, 50%. Now you have half your money. Are you seriously now going to say, it'll come back? I'm going to just hold on. No, you won't. That's why everybody bails at the 50% mark.
Right.
50% level it's not a real Fibonacci number. The only reason it's in those pull downs on the indicator is because
that's where most people their stomach
bail
blows
out.
Up.
Yeah.
They go, I can't take it anymore.
50% it tends to
be.
And
you have to keep reminding yourself that the market is made up of humans. Now there's a lot of institutions in there, but they're run by humans. Yep. Humans are driven by fear and greed. And so let's just say emotion, right? And over time, humans create patterns. Yep. And that's why these patterns actually work, right? That Jerry is showing you on these charts. These patterns happen because of human behavior.
Yep.
And once you can wrap your head around that, it starts to make more sense. And you go, okay, well, that's why these patterns exist, because humans create patterns, whether they want to or not. It's the way all analysis works when you're analyzing humans, right? Whether you're analyzing criminal behavior or you're doing military intelligence, all those analysts are analyzing human behavior. And it took me a long time to understand that that's what the market is, because I thought it was just math happening, and it is a lot of math. But really what's happening is human trends. Mm-hmm. And once you can figure that out, you go, okay, well, that made sense to me, because I thought, I know humans do patterns. It's a given. And so once you realize that and really accept it, you go, okay, well, then the market's going to have trends. Not necessarily that you can guess them.
No, I mean,
but you're going to recognize trends.
If the guy's walking down the street and every day at 11 o'clock he turns left, and you watch that for a couple of weeks, there's no saying that tomorrow when you go to snatch him up, he doesn't turn right.
But it's pretty likely he's going to turn left.
Yeah.
That's exactly the way it works.
All right. I would much rather talk about that stuff than this stuff. But at any rate, so the second question, we're not going to belabor this, but I have had it from a couple of people, and so I just want to make sure you guys understand. Every Friday night, we put out a slide that it's the market this week slide. It's what happened in the market. And so I got this comment on last week's and it says, hey, how about posting some more accurate numbers? Again, as for instance, the stock market ticker symbol EFA, supposedly the I fund, was up 0.25% today, yet the actual TSP I fund was down 0.8%. That's a 0.32% difference if you got $1 million, blah, blah, blah. I've noticed these discrepancies in the F fund as well. Just trying to say, I think your numbers could use some work, just a little constructive criticism. Okay. This is from the TSP.gov site. Okay, so this is the objective of each fund. And they only let you compare 3, which is why I don't have the F fund up here also, but I'll tell you what that is. So C fund, the objective, okay, the objective means it's not going to be exact. The objective is to match the performance of the S&P 500. Okay? The S fund objective is to match the Dow Jones completion total stock market index. The I fund is to match the Europe Asia Far East index, and the F fund is to match the Bloomberg aggregate bond index, which is the AGG. So each one of these has a ticker symbol that's associated with the index. The C fund, so the objective, again, it doesn't track it exactly. It's the objective. And if you guys ever sit on, I did it last year for months. If you sit on, there's a public call that the thrift retirement investment, thrift savings, whatever, the board, the FRB board, thrift savings board, does part of their monthly call for the public, right? A piece of it. And they go around the table and they talk about a lot of things, but one of the things they always talk about is the performance of each fund relative to its objective. So you got State Street, BlackRock, and I think there's one more now that has a little piece. So each of those institutions has a piece of the index, and you can listen to the call. There are reasons why the objective doesn't match exactly the index. Okay, I honestly cannot explain in any more detail than that the exact reason why the objective doesn't exactly match it. So the numbers, the final numbers, are the ones that are put out on the TSP website every day, right? I am not going through those numbers. You can, like, you guys go through those numbers. If you want the exact numbers from TSP, that's fine. What I'm using is the objective because it's close enough and it's much more simple to do. Okay, so if you follow SPY for the C fund, DWCPF for the S fund, EFA for the I fund, and AGG for the F fund. Those are the ticker symbols. Those are the ticker symbols that go to the objective. Okay, so yes, the numbers are going to be off a little bit because I'm posting the price movements for the week of the objective, not the actual fund. Does that make sense? Is there anything else I need to say about that?
It does to me.
Okay, good.
I don't know if that matters, but it does make sense to me.
All right. It matters. I mean, I understand. I understand because I'm putting it out as this is what the C fund did,
Right.
S fund did. So I appreciate the question, and
maybe what we should do, and this we do it, talk about it offline, but just so people understand, like, kind of how we come up with this stuff is, we'll probably just put a little disclaimer in the first comment. When you post that, we'll put what you just said in the first comment. That way, anybody that runs across it goes, oh, okay, I see why they're doing it. Because we're not going to go to the TSP site. And first of all, they don't, as far as I recall, it's not as quickly as it is done at the end of the day.
You get it the next morning.
So. Yeah, we're not going to go because we usually put that out on Friday afternoon. Jerry literally waits till the market close, puts that together and posts it out. And it's just for a little snapshot, right? We're not going to wait till Saturday morning, do it, and then put it out. And then, for 0.32% difference.
Yeah, no. And you'd have to, then I would be on the hook for actually making the calculations.
And that ain't going to happen.
Doing that.
It's not going to, sorry, that's transparency. No. Yeah. It ain't going to happen.
Okay, so completely switching gears, and we're not going to belabor this too much, but I think it's really, really important because it's what is driving the market right now, and it's what everybody's talking about. What happens when the Fed lowers rates? Okay. So there's like 3 things I really want to point out on this, and it's a really goofy looking chart, but kind of bear with me. So here we are back in the early 1950s. Okay. This is a chart. It's a monthly chart. This is the Fed funds rate on a logarithmic scale. Okay. So logarithmic scale means the the distance. So this is the rate side. The orange is the S&P 500. So here's the S&P 500 side. Here's the interest rate side, Fed funds rate side. So on a logarithmic scale, each distance is worth the same percent. Okay? So when they say, rates went up, whatever, 1%, if it goes from 1 to 1, I don't even want to explain it that way. You can see the value of the logarithmic scale is the visuals. So from the early 1950s to the top in 1982, the rate went from 0.9 to 21. Here was 21, so a little bit, so like 20%, right? And it went this distance. It's a huge move. And it took, 40 years, right? And that was the peak. But in the past couple years, the Fed has raised rates on a percentage basis way, way more than has been done ever. So to think that that's not going to have some kind of significant impact on the economy going forward is ridiculous. Okay, that's what they talk about, this long and variable lag. Nobody knows what's going to happen in the economy when you jack up rates. It doesn't matter what the number is. It matters the percent move, right? The distance of this line is way bigger than anything in here. Okay. So that's point number one. Point number two, what happens when the Fed lowers rates? Okay. Here's the best case scenario. So we had a peak in 1984 in rates. The Fed lowers rates. The S&P continues higher. Okay. We're having an orderly drawdown in rates, and the market continues higher. Okay. This was the 1987 crash, so kind of disregard that. But you can see, this is the point. Rates are coming down. Market's still going up. Everything's very, very orderly. That's good. Same thing happens in 1990. We had this recession, but it's not really, you don't really see it here. But this wasn't a great period for stocks. But over this time period, over that 5 years, the market's moving higher and rates are coming down. Okay, it's orderly. That's good. So that's like the Goldilocks scenario. So if the Fed keeps lowering rates, the F fund keeps going up, and the stock market keeps going up because we don't have a recession, right? It would look just like this. Rates come down, stocks go up, everybody's happy. And that's what the Fed is trying to create. And it's absolutely a possibility. On the other hand, you can have a peak in rates, a peak in stocks. Stocks start falling. Either rates come down first or stocks come down first. It doesn't really matter because it's achieving the same thing. Stocks start falling. The Fed starts cutting rates to try to put a floor in under the price of stocks that are falling. Okay. In that case, the F fund goes up. All the stock funds go down, but the F fund goes up. That was at the peak in 2000. And then the peak in 2007 was the same thing. Stocks are rolling over. Fed is pushing rates down in a hurry to try to put a floor under the crashing stock market. So, and then, they push rates down to basically zero, and they're there for years and years. This was the taper tantrum, they called it. And then we came right back down to zero again after COVID. So ideally, the Fed can orchestrate something like this, right? And the market keeps moving higher. That would be great. What we're trying to avoid is something like this. Okay. What's really interesting, not only is this by far the biggest move on a percentage basis in rates, but they did it in a declining stock market. Okay? Every time the Fed raises rates, right? Rates come up, the market has been going up. Rates go up, the market's going up. The Fed raises rates when the economy is strong. It doesn't raise rates when the stock market is tanking, which was a very strange thing in 2022, that the Fed continued to raise rates even as the market was down, at its peak, like down 30% on the C fund. So what we're up against basically is the biggest move in history of interest rates, and the Fed it paused. It definitely paused. So we're going to be, for some amount of time, rates will be where they are, and then they start cutting rates. And the question is, do we get rate cuts because of this, or do we get rate cuts that give us a Goldilocks scenario? So that's one tool, one analytical tool that you can look at to try to make decisions, rather than just saying, CNS buying over the last 30 years worked well. Like, I don't know. I'm not going to keep going back to that, but that's the thing. You can either use analysis of the economy and all the tools, rates, and all that, and make decisions and actually manage your money, or you can do some version of hoping for the best. All right, this was a similar and kind of more simplified chart from realinvestmentadvice.com. That's Lance Roberts' company down in Dallas. He's the guy that's on weekly on what used to be Wealthy On. It's now Thoughtful Money on YouTube. Great channel. So this is not a logarithmic scale. This is a regular nominal scale of the Fed funds rate on top, and the max drawdowns, which we call losses basically, the max drawdowns of the S&P 500 on the bottom. So what the chart is telling you is that when the Fed is in a rate cutting cycle, okay, we had a peak here, Fed's in a rate cutting cycle. This is the maximum amount of drawdown over the course of that rate cutting cycle. Okay. So here we are back in 1969, 70 we peak, and into 72 is this rate cutting cycle. And over the course of that time, the maximum drawdown was 27%. So you can see every time we have a rate cutting cycle, we have the market goes down. And so is this one going to be any different? We're going to start cutting rates, and then sometime in the future, somebody's going to be able to draw this, red candle, and how far, what's the maximum drawdown during that rate cut cycle? So it's happened every single time in the past. Is it likely? Well, you could say, let's see, this was a little mini drawdown or a little mini rate cut, and we didn't get a drawdown. All right, so it didn't happen every single time in the past. If you're going to bet against the market falling during a rate cutting cycle, it's either because you don't know it, you don't understand it, or you're hoping for the best. Okay, and having said all that, the market's still going up. So if we get back into today's view of the thing, this is the C fund. Here's the beginning of 21. Here's the beginning of 22. This is a weekly chart, right? So you can see we got a peak, got resistance at that line, resistance at this line. Huge breakout last week through that resistance. That's really, really bullish. Okay, the only resistance now, and we're only like 2% away from it, is that 4,800, the prior high. So it's almost guaranteed that the market keeps going higher from here. How far? I mean, you can do all kinds of analysis about how far should it go and everything else, and you can wring your hands about it's overextended. I'm going to get out and all that. As long as the market is trending in the direction that it's trending, it's going to go that way until the trend changes, and you want to identify that trend change as soon as possible. Not before it. That's a crystal ball. Not too far after it, because you're leaving money on the table, right? S fund, same kind of thing. Big resistance tops there, and we finally, last week, monster breakout through that level. And so what does that mean? this line was resistance back here, right? Now that we got above it, it should act as support. So if the S fund was to roll over, it could easily find support at that line and then keep moving higher. Because now this line should act as support. It should. Doesn't mean it will, but it should. So your risk, right? If you say, okay, I understand what you're saying. It broke out here. The odds are that it keeps going higher, so I'm going to get into the S fund to some amount. And I know that if it rolls over, I'm getting out of the S fund if it goes below there. So that's my risk. The potential return is big. This is what I'm risking. Okay, and if it rolls over, it rolls over, and you lost that amount. This is a game of probabilities and risk, right? iFund, same kind of thing. Market comes down, comes back up, hits resistance there, resistance. This week a breakout, not a very strong one. It's certainly not as strong as the S fund breakout. So I'm not sure that I would buy that if I wasn't already in it, but yeah, you get the idea. F fund we've been talking about a lot. We talked about it a lot on this show, but we've been talking about it for a long time because this 1, 2, 3, 4, 5 Elliott wave pattern has been setting up for a long time. Bonds are even still extremely undervalued relative to stocks. If the market rolls over and tanks, bonds, investors flee to the safety of bonds, so the price of bonds goes up. It's not to say that this is just going to keep going up, but the risk of losing money in bonds at this point is much less than the risk of stocks rolling over is the problem. So, all right. That was a long show. A lot of stuff to cover on there. If you guys liked it, great. Leave us some comments in the comments.
Yeah, if you like this kind of stuff, if you like the analysis, we do a lot more of it on our site.
Yep.
And if you have any questions,
Questions.
then you can just send them to us at support@growmytsp.com, or better yet, wherever you found the video, put it in the comment section, and we will do our best to get back to it. And if there is no comment section, send us an email, support@growmytsp.com. If you like the show, please share it with your friends. If you don't like the show, Merry Christmas anyway.
Merry Christmas.
We'll see you guys. We're out of here.